Have you ever seen a company report great numbers, only to watch its stock get absolutely hammered the next day? Well, that's exactly what just happened with Elastic. They reported their Q2 fiscal 26 earnings, and it created this classic Wall Street paradox. They delivered a strong beat, and yet the stock tanked. So what on earth happened? Let's dive in and break it all down. The numbers, the guidance, and our call on the stock from here.
Okay, so let's just lay out the core problem right here. On the one hand, you have the results. Non-GAAP earnings per share came in at 64 cents, which smashed the consensus estimate by a solid 10%. Revenue, $423 million, growing a very healthy 16% year over year. By any normal measure, that's a great quarter. But then you look at the market's reaction. Just brutal. The stock dropped almost 15% on trading volume that was more than double the daily average.
And this whole disconnect is captured perfectly by the CEO's own words from the earnings call. Ash Kulkarni called it an outstanding quarter. So you've got this massive gap between how the people running the company see the business and how Wall Street decided to value it overnight. That's the mystery we're here to solve. So first up, let's dig into the numbers behind that outstanding quarter. We need to understand why everything looked so good on the surface. Now, when you break down that revenue, things get even more interesting. You see, their main growth engine, Elastic Cloud, is still firing on all cylinders. It grew 22% year over year. The bulk of their business, the sales-led subscriptions, also grew a really solid 18%. I mean, come on, these are not the numbers of a company that's in any kind of trouble. And when you look under the hood, the metrics were just as strong. Their current RPO, which is basically a great indicator of future revenue that's already booked, grew 17%. The company now has more than 1,600 customers spending over $100,000 a year. And get this, they signed over 30 deals worth more than $1 million each. So on paper, this business looks rock solid, right? But here's the thing you always have to remember about the market. It's a forward-looking machine. The past quarter is ancient history the second it's reported. The real story, the one that moves stocks, is almost always hidden in the guidance. And this is where we start to see some cracks appear. So, we come back to that central question. If the results were solid and the business metrics looked healthy, what in the world sent investors running for the exits so fast? Well, the answer wasn't some huge catastrophe. It was a really subtle but important shift in the growth story. And boom, here it is. This table tells you pretty much everything you need to know. Look at that slight deceleration. Total revenue growth, which was 16% in the quarter they just reported, is now guided to slow down to about 15% next quarter. Sales-led subscription growth is guided to dip from 18% to 17%. Now, I know these seem like tiny changes, but for a high-flying tech stock with a premium valuation, any sign of slowing down is a major red flag. So here's the crucial point. Yeah, Elastic actually raised its forecast for the full year, which sounds great. But if you do the math, it implies that growth in the second half of the year is going to be even slower. The market had priced this stock for perfection. It was expecting growth to stay strong or even accelerate. What it got instead was a signal of a gradual slowdown. For a stock trading at a high multiple, that just wasn't good enough. Okay, so that brings us to the verdict. How did traders and big institutions take this subtle guidance and turn it into such a massive price drop? Well, just look at the volume. This was not a knee-jerk reaction from a few small-time traders. Nearly 9 million shares changed hands. That means the big money, the institutions, were selling. This was a high-conviction move to fundamentally reprice the stock based on that new, slightly slower growth path. And of course, the Wall Street analysts were right behind them, cutting their price targets. Bank of America dropped theirs to $90, Stifel trimmed theirs to $108. The thinking was all the same. The business isn't broken, not at all, but the valuation on the stock just got a reality check. It needed a reset to match this new growth outlook. This is a textbook example of something investors call multiple compression. Think of it this way. The company's earnings are still strong, but the market is suddenly not willing to pay as much for every dollar of those future earnings. The price-to-earnings ratio shrinks, and the stock price falls to reflect that, even if the business itself is doing fine. But hold on, it's not all doom and gloom here. Despite that valuation reset, you absolutely cannot ignore the bull case for this company. Elastic's foundation, especially its deep roots in artificial intelligence, is still incredibly strong. That's a huge part of the long-term story. And a key piece of that story is just how deeply embedded they are in large companies. Just look at this number, over 1,600. That's how many customers are now spending more than $100,000 a year with Elastic. It proves their platform isn't a nice to have, it's mission critical. Plus, management isn't just talking about AI. They're executing. They're shipping innovative new products like Agent Builder. They're making smart acquisitions like Jina AI to get even better at search. And they're getting that crucial third-party validation, being named a leader in their space by industry analysts like IDC. They are delivering. And maybe the biggest vote of confidence of all is coming from management themselves. They have a $500 million share buyback program active, and they put their money where their mouth is, buying back over $114 million worth of shares this past quarter. That tells you they clearly believe their own stock is a bargain after this drop. So, all of that brings us to our final segment, the next call. After digging through the quarter, the guidance, and the reaction, what's our official take on the stock from here? This is the big question every investor is asking right now. After a 15% haircut, is this a screaming buy or is it a warning sign to stay away? Let's lay out our prediction for what happens next. For the next quarter, Q3, we expect Elastic to report right in the middle of its guidance. We're penciling in revenue of $438 million and earnings per share of 65 cents. As for the stock price, we believe it's probably going to be stuck in a range for a while, let's say between $68 and $80, as the market just digests this new reality and waits for more proof that growth can stabilize. Therefore, our rating on Elastic is market perform. The thesis here is pretty straightforward. After that big sell-off, the stock is now what we'd call fairly valued. It's a strong company with a fantastic AI platform, but its price now accurately reflects the mid-teens growth that management is guiding to. At this point, the risk and the reward look pretty balanced. And as always, a final reminder, this is not financial advice.